and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your co-host, Desi Troncoso. We are on episode number 13. If you were with us on our last podcast, episode 12, Denny and I interviewed commercial real estate appraiser Rusty Rich. This is a great episode for those wanting to know how appraisers come up with their values on the purchase or sale of a property. If you want to learn more about how to come up with an offer or how to price your property competitively, make sure to listen to that podcast. In this episode, Denny and I discussed the rule of 72. We will talk about the differences about simple and compound interest, and why Albert Einstein calls compound interest the most powerful force in the universe. As always, be ready to take notes. If you don't already, please follow us on Instagram at Denny Troncoso and myself at Desi Troncoso. All right, so let's get started. Denny, are you there?
Yep, I'm here. How's it going, Desi?
It's going good. How's it going with you?
Oh man, it's cold in Florida. It's what is it? 40 today?
Yeah, well, it's 60, but it was in the 40s in the morning.
Yeah, it was 40 this morning, and then it's 60 now. And but I mean, Christmas season is here, and I like the holidays, and it's not so hot anymore, right? Because it was just so sticky. Right, when it was hot.
So sticky. Humid. No, it definitely makes the holidays feel more holiday-ish as the season git cooler.
Yep. I like that.
All we need is snow.
Yeah, I took a picture by the what was it, the Grinch? It wasn't a statue. It was like one of those
blow up. Yeah.
This morning at the gym, and I enjoyed that. So that the holidays are here because the Grinch is here.
We all know that. All right. So I know today we have a fun phone call that's filled with a lot of information. And I want us to go ahead and get started because it's important.
Yeah, definitely. And it's a great episode because it takes us a little bit different from the real estate realm specifically. So we can kind of talk about more general investing and some investment principles. I'm excited.
Yeah, and I think it's great way for people to understand different strategies for investing. Mm-hmm. That's why I'm excited about this episode as well. And even I hope to learn a few nuggets as well myself.
Hey, let's see.
All right. So before we get started, of course, talking more about how the rule of 72 works, we all need to understand more about what it is. So can you explain a little bit more about what the rule of 72 is?
Well, I mean, that's a great question, and I want to keep it as simple as possible. But I want, first of all, start with the Rule 72 with a quote. And Albert Einstein said that one of the most powerful forces in the universe is compound interest. Right?
There you go.
And the Rule of 72, what it does, it helps to calculate your return, how fast your money doubles using compounded returns. All right? So we're going to break that down so we understand the basics. A rule of thumb to help you answer this, what it is how long is it going to take to double my money? So if you have that question, the rule of 72 is going to help you answer it.
Okay, perfect. And I know if Albert Einstein said this, then it must be true. And it must work.
Yeah, no, smart guy. There's a few things that you're going to need to be able to really take advantage of the rule. We need to know, once we know how long it will take to double our money, and we're going to talk about this on the call, but we want to know how many compounding periods do we have in our lives based on our age. So if you're older, you're going to have less periods that your money's going to double because you're older.
Right.
And if you're younger, you're going to have more. And then you also need to have what your average return of the investments that you play in, if you're in stocks, if you're in mutual funds, if you're in real estate, and what's the average return that you're getting. And then you want to know what your target retirement age is. And the reason we need to know that is because at that point you may not be investing in the same type of investments. You may kind of want to just have your money in more safer investments that are not in generating such high returns because you want it for cash flow and you want it to stay stable for a long period of time.
Okay, so I know in the beginning of the call, in the intro, we've mentioned that there were factors that affected the compounding interest. And are these the factors that go into play when we're trying to calculate how it works in doubling our money?
Yes, I would say that these are some of the major factors that you're going to need to know when you're using the rule of 72.
Okay, and the factors are, again, it is based on our age.
Mm-hmm.
The average rate of return of the investments,
Mm-hmm.
and our target retirement age.
Yes, those are the three other variables that you're going to need
Okay.
to know, to take advantage of the rule.
Okay, great. All right.
Now, before we even get to the rule of 72 and compound interest, let's learn a little bit or kind of have a little bit of a lesson on how you're going to use it, because you can't use it for all types of interest returns. You can't use it for all type of investments. You can only use it for compounded interest investments. So there's two types of interest that you can earn. There's simple interest and there's compounded interest.
Okay.
All right. And then simple interest is interest earned on principal. So you make an investment, $100,000, you're going to earn interest on that principal, and then you're going to get interest paid every month, every quarter, every year. The interest is not going to be reinvested by the company in that investment. That's why it's called simple interest. So simply, it's in your pocket.
Okay.
All right. Now, something to take advantage to learn about that is that you're going to multiply the investment that you made by the interest that you're getting. So if it's $100,000, it's times 5%, $5,000 a year. That's going to be your simple interest return.
Okay.
All right. If it's, we'll have an example in a little bit, but that's a kind of easy method. So far, so good?
Yeah, that makes sense. So if I invest $100,000, what you're saying, and then you have your interest rate that you multiply by, the $5,000 was what the annual amount of money I'm basically getting into my pocket for that particular investment.
Yeah. If it's simple interest, and we're using easy math.
Of course.
It's going to be a little different because if you're getting monthly payments on your investment, let's say you made a loan, it's going to be a little different. And we're going to go over an example because I don't want to jump the gun, but so you have an idea. It's used to calculate interest on investments where the interest is not invested back into the investment. Just remember that, all right? Very important. Simple interest. The next one is we're going to go over an example, and this is if you borrowed, because it works two ways, right?
Okay.
You could be an investor or you could be a borrower, and you're either using one of the two, compounded interest or simple interest. In this example, let's look at a car loan. Car loans are based on simple interest most of the time, and you borrow $10,000 at 5% for, let's say, 60 months, 5 years. The payment's going to stay the same, but the interest and principal that you're going to be paying is going to be different.
Right.
Okay.
Mm-hmm.
So the first payment that you make, you multiply 5% times the $10,000, you get $500, right? You divide that, and that's going to be your total interest for the year.
Okay. So your example, we're using a car. We're buying a car.
Yep.
The loan amount is
$10,000.
$10,000. The interest rate is
5%.
Okay. So
I love 5% interest.
I can tell. It's easy math. It's easy
right?
math.
It is.
So from there, it equals $500
Of interest. For the year.
For the year.
All
okay.
right.
And of course, we want to divide that by 12 because there's 12 months in a year.
Uh-huh.
In order for us to understand what we're paying for the month, which is the $41.66. About something like that.
More or less in interest. That's how much you're going to be paying that month in interest. But you're also going to be paying principal.
Right, exactly.
So the following month 2, you multiply the 5% to the remaining balance of your loan, which is not going to be $10,000 anymore. It'll be maybe $9,800 and something.
Right, because you made payments.
You made a payment. Now your interest is based on that 5%. Again, now you're going to get a different number.
You have to recalculate it every month.
Every single month.
Yeah, because, and for those who may have houses or car loans, you know that you are paying higher interest in the beginning, and as you get closer to the end of the loan is when you pay more toward principal, right?
Exactly.
So then we're calculating what that interest is in the beginning, a lot of the times the payment, because the interest is higher, just to understand more of what you're paying on interest.
Exactly.
And then if you reverse it, if you're doing this loan for someone, this is what you would be earning in interest.
Correct.
Okay.
Correct. Now, let's look at an investment now.
Yes.
All right? That's an investment that pays simple interest. And I wanted to use a bond, right? So a bond is a debt when you are loaning your money to a corporation or to the government. So that's a bond.
Right.
They're paying you a interest payment on the money you lend them. And we invest the money and we get a semi-annual interest return. That's how bonds work. They typically pay you every 6 months. So at the end of the 5 years, they're going to go ahead, or 3 years or 3 months, however long the bond is. Their bonds are different. They'll pay you your final balance, but every single year they're paying you the amount of interest that they owe you.
By final balance, you mean the amount of money you gave to them?
Yes, you give them $100,000, same $100,000. You multiply that times 5%. Every year they're going to give you $5,000, right? Then at the end of 5 years or however long the bond is, they give you your $100,000 back.
Okay. Yep.
Right? Simple interest.
Yep.
Right.
Again, it's easy to remember. Simple interest is the interest earned on the principal.
That's it.
And if you just kind of think of that with the examples, it makes more sense.
Yep.
Very good. Okay.
Now, there's good and bad things.
Of course. So let's talk a little bit more about maybe what some of the positives or negatives would be in doing simple interest.
Okay, so some of the positives are that you get periodic cash flow when you invest. So this is great for people that are looking to make an investment, but it's not necessarily just to retire one day. They want to use the cash flow to live. They want to use the cash flow so they can go traveling. They want to use their cash flow to pay their bills. They're making that investment to supplement their income. This is a good simple interest investment. The other is that it's lower. Another positive, it has when you're borrowing, it has lower overall interest that you're going to be paying because you have a specific payment. You're not going to comparing it to compound interest. You're going to pay less interest over time. And we're going to go over an example of compound interest in a minute.
Okay.
Now, some of the negatives are that it has potentially lower overall returns than investments that have compound interest. And when borrowing, potentially you're going to be paying excess debt. And it's going to accumulate higher and it's going to accumulate faster.
Okay.
Right? So you have to be careful with it. It's good when you're investing, bad when you're borrowing. Right?
Yeah, exactly. That's what I was going to touch on. It depends on what end of the spectrum you are. As an investor, of course, receiving the interest is great when it's higher, but as a borrower, you definitely want to minimize.
That's right.
Okay, great. So, do you have anything else to add about simple interest? I think I understand more about simple interest before we go into compounding.
No, I think we touched on quite a bit of it.
Okay, great. So, the next one that we're going to talk about, and this is the one that goes more with the rule of 72, is compound interest. So, can you tell us what it is?
The simple answer is compound interest is when you're earning interest on interest. So you made an investment, and that investment, you made a $100,000 investment in a fund, mutual fund, let's say. You're getting a 5% return, but instead of them sending you a check every single month or depositing the money in your bank account every quarter, every 6 months, every year, what they're doing is they're saying, okay, we have 5%, but instead of paying it out to you, we're going to reinvest it in the fund. And then now that 5% is growing on top of with what you already invested. So now instead of having $100,000 invested, now you have $105,000 invested. And it just keeps growing on top of each other. And that's the magic, what they say, that it's a snowball effect.
Right.
They also call it the most powerful force in the universe because of that.
When it comes to finances.
Definitely, yeah. Definitely.
Very good. Okay, so that makes sense. So you're basically getting an original investment of $100,000 and then you're trying to double your money, you can really say, because you're taking your original investment, now you're including whatever interest you may have gotten, which would be the 105, and now you're reinvesting that, so then that is where it's going to start doubling because you're going to start accruing more and more.
Well, everyone wants to double their money,
right?
But well, we're going to talk about the rule of 72 and the doubling part, because there we're talking about how quickly it doubles is what we're going to talk about.
Right, exactly.
But with the compound interest part, we're talking about the snowball effect, right, of the investment. And we're also talking about that you're not going to be withdrawing the interest every single month. You're actually reinvesting it in that particular fund, right? And then we'll talk about some hybrid ways you could use it as well later. But let's go over some examples.
Yes.
Right?
That always helps.
Yeah, I think it definitely helps me. So borrowing, if you're using it for borrowing, this is really the what you want to avoid, and this is credit cards. And student loans actually also work with compound interest, because what they allow you to do is they allow you to make your minimum payment to be less than the accrued interest. So let's use an example. You owe $1,000 on a credit card, and the interest for that $1,000 is, let's say it's 10%. That's $100. But the credit card sends you a bill and says your minimum payment is $25.
Yes.
Right? So you make a $25 minimum payment and you're like, yeah, I just made the minimum payment. I'm paying on time. This is great. But guess what happens next month? Next month they send you a bill, and instead of the payment, the bill the total going down to $950 or $975 because you made $25, you actually owed them $75. So it gets added up to the principal. So now you owe $1,075. So next month they're gonna say, okay, now 10% times $1,075.
Yeah.
And then compound interest is working against you.
Right. Exactly. So basically, what is happening is they're telling you only owe a certain minimum when your interest for that example was $100, but you're only making $25 payment. So you're not you're definitely not covering the amount of money you put on the card, which was originally $1,000.
Yep.
But you're not even making a payment that will cover the interest that has accrued on that, which is $100. You still have about 75, because you only made $25 payment. Yeah, you only made
interest
that's left over.
Yeah, so that gets just added back.
So it gets added back, and then you're doing this again the following month. Well, that 75 now has become another 140. So
and
it starts
snowballs.
to cycle.
Yeah, it really starts growing, and that's why there's calculators out there now. I think credit card companies are required on the statement. It tells you if you only make the minimum payment, this is how long it's going to take you to pay off your debt. And I'm not sure exactly how those calculators work, because technically if you just make the minimum payment, it's never going to be paid off.
Well, you're going to end up owing more.
Yeah, because you end up owing more. But they have, I guess maybe they have something in their calculators where it works different. But
awesome. So that's on the bad side, which is the borrowing. That's money going out of the pocket.
Yes.
So let's focus on, because we're building wealth here, the investment side and how we are putting the money to use for ourselves.
The way that we're putting the money to use is when we're investing in something like a mutual fund or a money market account. And we invested $100,000, and then this month the fund did fantastic, or let's say this year the fund did fantastic and we earned 10%. So we grew our $100,000 to $110,000, and instead of the mutual fund, and it's an option that we have in the mutual funds. They ask you, do you want to reinvest the dividends, or do you want to receive them in your bank account? And you choose to reinvest it, and then next year instead of investing $100,000, they invest $110,000 for you. So now you're getting interest on top of what you originally invested.
Okay.
Right?
Yes.
So there's several funds, and then the fun part of this call is I'm going to also share some investments to take advantage of with the different types of interest returns. All right?
Okay, great. We'll look forward to that. So what are some, we heard a little bit more, the positives and the negatives with the simple interest. Are there any with the compound interest? I mean, I think we've heard what the bad is, but can you go over those a little bit more?
Well, it can make the investment, the money grow to a higher amount at a faster rate compared to that from simple interest. So you can earn more money with your investments using compound interest returns versus simple interest returns. Okay, it's possible. Every investment is different. It potentially, or it depends, as one of my professors said. The other thing is you can, because of that, so you're going to earn higher potential returns, bottom line. The bad thing is now you don't have any cash flow, right? Because you're reinvesting it, right? Mm-hmm. So if you're looking for cash flow, then compounded interest is probably not the best thing for you, right?
Okay.
Or maybe you don't want to invest all your money in compounded interest ways. Maybe you want to have both types.
Yeah. So if you're wanting the cash flow, it's really good to do the simple interest. And then if you're not looking to get cash flow immediately, maybe you're looking for the long term where you're wanting a larger amount of capital per se, then the compound interest is really going to be the type of investment you're looking for.
Well said.
Told you, I'm learning here.
Yeah, no, this is good. So why did we go through this, right? Because this is the title of this episode is the Rule of 72. But if we don't understand what type of interest, you can't use the Rule of 72 because it doesn't work for simple interest. It only works for compounded interest. Now let's get to the meat and potatoes.
Okay, so the Rule of 72, like we said, no simple interest. It doesn't work. You have to use compound interest.
That's right.
All right. So how does this apply to investments? How does the Rule of 72 apply to investments?
Well, it's a rule of thumb.
Yep.
And what it allows you to do, it allows you to calculate how fast your money is going to double, depending on the return that you're getting. It's 72 divided by the rate of return that you're getting. So if you're getting 12%, 72 divided by 12%, that's going to give you the amount of years it takes you to double your money. Let's go over an example. We love examples, right?
Well, we have to understand how it works. Yeah. We want to learn how we apply it.
That's right.
Yes, examples are important.
Yeah, so 72 divided by 12% equals 6, or 6 years more or less. It's a rule of thumb. Our money's gonna double every 6 years. So we have $100,000 again in this example, and if we leave our money getting 12% compounded interest in about 6 years, we'll have $200,000.
Ah, got it. Okay. And just so that you guys know, the interest we are coming up with, there's not a rule book for it. We're just using examples so that when you look for investments, you'll have an idea how it works. But they're just, I know sometimes we get questions, well, where are they getting the 12% from? They're just made up numbers. We're just trying to help you understand how it works.
Yeah, and then in future episodes, we'll talk about funds and how to evaluate which ones have the returns.
Exactly.
And different things.
Okay, great. So we did the 12%. Let's do something that is a little bit more common. We see 8%, a little bit more common in the industry for investments. How long will it take for us to double our money with that?
72 divided by 8 equals 9 years.
8%, yeah.
Yeah. So if now in this particular example, it took us 9 years to double our money, 3 more years to have that $200,000. And we're going to get to it, but it's powerful because think about it. If you're younger, you may have some more time, but if you're older, you don't really have that many options. So you need to
look for something that has a higher interest rate, basically, to double it faster.
Yes, as long as you're comfortable with the risk and the investment type, and now we'll talk about that as well. Okay. But the last example, also wanted to go over with an even lower return. 6%, 72 divided by 6% is 12 years. I don't even want to put it in here, but imagine when you're having your money at the bank in a CD that's earning 2%, right?
Yeah.
I don't even want to put it there. Okay? It's terrible. Okay? So the rule also means if you want to double your money faster, in 6 years, in 4 years, you need to be earning much higher returns. So you need to be looking for that to take advantage of those returns to double your money faster.
Yes, I do agree with that. Okay, great.
Now, to use the rule of 72 to your benefit, we also need to know the number of doubling periods we have prior to our retirement. And to calculate that, we need to know three things. We need to know what's your current age. We need to know what's the average rate of return of your preferred investment. And we need to know your target retirement age.
Okay, so we're basically trying to find out, for example, someone that is 30.
Mm-hmm.
We're trying to calculate how many periods, like we said, the doubling periods, the 100,000 to 200,000, it would take, or how many of those we need to have a certain amount of money before we retire.
What we would say is we're looking to know if we want to have this amount of money.
Yes.
Right? How many of those doubling periods do we actually have?
Great.
Right? How many times is our money going to be able to double if
Okay.
we're getting 12%?
Okay.
Right? And let's go over some examples. I think Desi's favorite. So, the example is 25-year-old man named Will. He's getting a rate of return of 12%. He has a retirement goal of age 60. So
Okay.
he has quite a bit of time. If between 25 and 60, that's with 35 years. And if you divide 72 divided by 12, which is the rate of return he's getting, you equals 6, which is his money is doubling every 6 years. All right? Now, how do we get the amount of doubling periods, right? It's another formula, trying to keep it simple. So the retirement goal is age 60. We subtract that by his age of 25. We get 35 years until retirement.
Yes.
All right? Now, we divide that by 6, which is the amount of time it takes his money to double, and we get 5.83. Let's just round that to 6, right? To be kind of get it to closer. So he's going to have 6 doubling periods between the ages of 25 and 60, more or less.
Okay, so to be more specific, we would have to make sure that we have 5 periods within the time I'm 25 till I retire at 60, where I'm going from 100 to 200.
Yes.
Okay.
Well, and then it's not going to, and it's magical. So it's actually not just happening 100 to 200. So think about
200 to 400.
Yeah,
And then
exactly.
so forth and so on.
So you have 6 of those.
Yeah.
Right? So you have 100 to 200. He's 31. Then you have 200 to 200,000 to 400,000. He's 37. Then 400,000 to 800,000. He's 43. And then we'll keep on going there.
Okay. Yeah, that makes sense.
That makes sense. Now, to calculate, there's tons of compound interest calculators on the web, so you can Google it. I found one on investor.gov, so this is a government website, and I used $100,000, and I used 12%.
Has your initial investment, the 100,000?
The $100,000 was your initial investment at age 25. This is for Will, our example. And then he wants to retire at age 60, and he's going to get 12%. And at age 60, he wants to retire by age 60 at 12%. And his initial investment is $100,000. He will have $5,279,961 by age 60. Boom. And that's huge. He started off with $100,000, and in this example, he didn't put any more money in. He just let that money grow at that 12% number.
Okay. And that's at 12%. So what about 6%?
Yeah. If it was at 6%, we would say that he probably should have at least half, right?
Yes.
That's what the percentage is. He's only getting half of the percentage. He should have half of the number. Well, compound interest doesn't work that way because you're not getting the return on interest on interest.
Right.
So it's actually only $768,000 $608.
And that's a big difference between the two of them.
That's a huge difference. If you think of retirement on a quality of living, quality of life, how you can live on $5 million compared to $700,000, it's drastic difference, right? You're living, a completely different life. Right?
Yeah, and that's why this is so important as well. I know we didn't probably mention it in the first intro, but this is so important for everyone to understand, because when you retire, you aren't really going to, you don't know what's going to happen in the future. If you're going to be able to work, health and things just happen, right? But it's important to plan for your future for when you do retire, to make sure you have enough funds to support yourself. Because there are some, of course, prices are going up every day, but we don't know with Social Security, there's a lot of things that can happen, that's not guaranteed.
In the end, what I was going to say is you bring up a good point, and you don't get any second chances,
right? With
retirement, there's only one retirement for you. So you have to use it to the maximum. And if you have the opportunity to have additional times to double your money, why not take advantage of it? Right? Why not take advantage of it? Invest where you're comfortable. And we'll talk about the different investment types. And I don't want you to try shooting for high return investments if that's not what you're comfortable with. But just know what you're getting into and know what to expect. So you can live the life that you want to live based on that.
And I think if there's one thing that, of course, you focus on, because I know we're so busy, it is trying to focus on retirement as well. So you know how well you're going to be when you're ready to do that. So, great. All right. So we did a 25-year-old. Let's do maybe someone that is a little bit further along the way in their life journey. What about someone that's 50 years old? How would this rule of 72 work?
All right. So this example, we have Dolores. And Dolores is 50 years old. A very nice lady. And William was good too. He was a great guy too. And Dolores is also investing with a similar rate of return. The rate of return is 12%. Kept it the same as that Will's getting. Her retirement goal is 65, so she wants to work for another 15 years. And if we take 72, we divide it by 12%. Just divide it by 12, we get 6. So we get 6 years. Her money's doubling every 6 years. She has doubling periods. We take her retirement age minus her current age of 50. 65 minus 50, we get 15. And we divide that by 6. So we get 2.5 doubling periods that are remaining in her investment horizon. Yeah. So she's still going to be alive and well and kicking, right? Because life doesn't end at 65, right? There's a lot more fun after 65, but that's when she's going to retire.
Right.
All right. And she's not going to be earning 12% after 65 because she wants to go put the money in bonds or whatever she wants to do. So according to investor.gov's compound interest calculator, she invests $100,000. By age 65 at 12%, she will have $547,356, right? Now, I don't want you to worry about Dolores because Dolores is really well. She has other investments, right? I didn't talk about that. But based on this $100,000 that she invested by age 65, she'll have $547,000. But if it was at 6%, how much would it be? $239,000. A big difference. The difference between the two is $300,000.
Right.
All right, for an investor. So she, by investing at 6%, she left $307,000 on the table.
That's a lot.
That is a lot of money. And maybe Dolores wanted to do that. Maybe she was like, you know what? I only like investments that generate 6%. So that's fine if she knew that. But if she really wanted to earn the $307,000 and she was willing to go with an investment that earned 12%, then it was good for her to be aware of this information.
And I'm thinking, because the 12% is so much higher than the 6%, that a lot more risk is associated with those type of investments, and that's why the rate is so much higher. And so I think, like you were saying, it really just depends on their risk tolerance. at that point, whether they want to do 6 or 12%. What are your thoughts on that?
Yeah, that's a great question. And what I'll say with this is risk is subjective, right? And they say that if you're earning a 12% return, you're going into a fund that has much more fluctuation. And just because the fund fluctuates doesn't mean that it's necessarily riskier. What I would recommend for Dolores or anyone looking to do different types of investments is to learn, right? And we'll probably talk about that because it may be riskier, but it may not be. You really need to learn about the different funds.
We heard all the great information on how the rule of 72 will work for us. Is there anything negative about the rule of 72 that we should be aware of, or does it work against us in any way?
Well, and we've touched a little bit on this, but it's debt, and debt again. If you're paying down debt and the rule 72, compounding interest, it's working against you. If you divide 72 divided by 20%, let's say some credit cards are 20%, 28%.
Interest?
Yeah, the interest is super high. So 72 divided by a 20% interest credit card equals 3.6 years. So that means your balance is going to double every 3.6 years.
Oh, wow.
In fact, even in this example, this is at 20%. The balance is going to double every 3.6 years at 20%. $15,000 will become $30,000 in 3.6 years and $30,000 in 7.2 years.
Wow.
This is why having debt with a set payoff date with simple interest is probably better.
Yeah, I agree. Well, now we know all that information of how it works and also some things to be aware of. Earlier in the podcast, you mentioned that you would go over some investment types that are attributed to both of the compound interest and simple interest. Can we go over those now?
Yeah, this is a great time for it.
Yeah.
So under compound interest, we're going to have mutual funds, right? We're going to have index funds. And these are funds that you can invest money in. And they're managed by a professional money managers, they call them. And they manage the money for you. And the money is in mutual funds in particular. Is the professional money managers. They invest it in different companies. You get a nice return on that money. You can set it up with automatic reinvestment rates. That's mutual funds. A difference is index funds. And index funds it's actually not managed by a professional money manager. You're investing in an index, let's say like the Standard & Poor's 500. So you're investing in 500 companies, equal amount in each company, and you're just riding the market and seeing how the market does. And a lot of studies have said that index funds are actually a better investment than mutual funds because most people can't beat the market, right? And then you have hedge funds, you have ETFs or exchange traded funds, which have some benefits too, and we'll be able to discuss some of these in future podcasts. Then you have money market accounts, CDs, which you want to stay away from. Zero coupon bonds, zero coupon bonds are bonds that they pay you all your money at the end of the investment period. Be careful with those two unless you're loaning to very high grade companies, so very strong, reputable companies. And then those are some compounded interest examples. The other one is simple interest investments. And if you make a loan to someone and collect interest, that's based on simple interest because they're paying you all the interest right then and there.
So like a private investor loan?
A private investor loan.
Seller financing? Seller
financing loan if you're seller financing a house or even financing somebody's car, which, you want to be careful with that. Then simple interest investments are syndicated investment in an apartment building where you invest in somebody that's some of the stuff we do, which we buy apartment buildings and we bring investors and then they become owners in the apartments. That's considered a simple interest investment. They get part of the cash flow, but then they also get part of the sale. Equity ownership in a startup. So if you're investing in a startup company, that could be possibly a simple interest investment. You're going to own the company. Maybe they're paying you interest if it's equity, if it's preferred shares. It just depends on the setup there. Bonds, stocks, and real estate investment trusts or REITs. Now, I will say that something that some investments offering simple interest returns, like syndicated apartment investments, which we structure, have other benefits as well, like above average market returns, right? So sometimes the market may be doing 10, 12%. Maybe we're targeting 15, 20% with some of the investments that we find. There's tax benefits from depreciation or 1031 exchanges.
A lot of those going on lately.
Yeah, there's quite a bit. But just make sure you're finding reputable people that have done this before. Then less fluctuation of returns still to people needing a place to live, right? So if you're investing in apartment buildings, most of the people need a place that they need to live instead of like an office building where maybe if the economy tanks, you don't need as many employees and etc. Diversification from the stock market by owning a physical asset. Maybe you want to be in the stock market, but you also want to be outside of it. So you want to have a physical asset. Inflation adjusted returns or a hedge against the stock market, because if you have leases and when inflation goes up, leases go up, the rents go up, so you can hedge against the stock market. And then the last one is of professional asset and property management. So that's something that you have somebody else that's an expert that's doing that. You don't have to deal with it. You're not the expert. So, some benefits of the syndicated apartment investments that I definitely want to mention. And with that, this is something that you mentioned earlier, and you asked, what about the hybrid options about using the Rule of 72? And some of the hybrid options of using the Rule of 72 are, let's say you buy an investment in investment A with simple interest, and you reinvest the cash flow. Let's say you got into a syndicated apartment investment, you receive monthly, quarterly distributions, but instead of taking the money and going shopping or going on vacation, you say, you know what, I don't need the money right now. I want to go ahead and continue to grow my investment money pot. And I invested it in a mutual fund, or I invested in an index fund that the money's going to continue to keep compounding. So it's just like a hybrid way to use it. This would work if you don't need the cash flow. So in that particular case, now you can use the Rule of 72 to get an idea of what you're earning on the return. There's actually a completely different formula to calculate how fast your money is doubling with simple interest, but it's beyond the scope of a podcast call because it's a little complex, right? Maybe one day we'll do a YouTube video or something on that.
Now, the golden question is, what should I invest in? You gave us so many options of investments.
So many options, their heads probably spinning.
Yes. What is your recommendation? What should someone invest in?
Well, this is an easy answer. It depends.
That's what our attorney says all the time.
It depends. What I will say is I'll share some recommendations on how to find what you should invest in. And the first one I'll say is find what you're comfortable with.
Yeah, I think we kind of talked about this earlier with Dolores. Versus the 12% versus the 6%, risk tolerance, depending on what it is. But find what you're comfortable with. If you're more comfortable with this investment, like real estate, then go for real estate. But if real estate scares you, don't invest in real estate. Find the investment that you're comfortable with. Determine what types of returns you want to receive. If you're targeting, let's say 15%, 10%, 12%, 8%, you say, okay, now what investments generate that? And maybe to get more comfortable with it, you need to learn a little bit more about it so you can understand it and see what other people have, how they've done, and that way you can make better decisions for yourself with that. Try to obtain the highest return with the least amount of risk is a good one. Risk can be reduced in all type of investments. How can you do that? Something I've already said, by getting an education and learning about the different investment types and what things you can do to lower that amount of risk, so you can get a great return, but you're not putting
your nest egg at risk, you know?
Yeah, and I think that's something we talk a lot about. I feel like we almost are continuously
Beat the horse.
harping on that. But I mean, at the end of the day, it is what it is. You really, in order for you to be successful at something, you have to understand how it works, what's involved, you know, how to get to an end result, right? It's like learning math, you know, the 1 + 1 = 2. You need to know the same thing about investments. So, I mean, education is going to be a big part of that. You know, someone said once, you don't need to be the expert, but know enough that you're deadly.
Man, that's perfect. I was thinking the same thing. I think you just need to understand some of the basics. So when you see an investment, you're like, okay, I don't know every single thing about how my car works, but I know when the oil change light comes on, I need to go to a mechanic. Right? You don't need to understand everything, but you do need to understand the basics. And what that's going to do is that's going to allow you to participate in investments that maybe you wouldn't. They're going to allow you to earn a higher return. It's also going to prevent you from being taken advantage of by people that are out there doing investments, but also big corporations, right? And we'll talk about that in future calls, where some of the expenses in some of these funds are super high, which you need to be careful with as well. The last one I say is diversify and focus. So if you hate real estate, but you want to diversify, maybe try investing in REITs and real estate investment trusts. If you want to diversify in real estate, invest in different asset classes in different geographic areas. So find ways to, as the saying goes, what is it? Eat your cake and have it too. So you have it there, but then eat it. And I always thought about this: like, why would you want to eat the cake, have the cake, if you eat the cake?
Well, no, I always just ask, why are you going to have the cake there and not eat it? Cake is meant for eating.
Well, what they're saying is, I think you want to look at the cake there, you want to look at it and admire it, and then you want to eat it to taste it. So
great.
With that. Now, what else do we have? Anything we want to share some fun stuff on how to use the Rule of 72?
Yeah, let's hear it.
So you can actually use it for other things as well, like to calculate how fast the economy is growing in size. So say you want to invest in a specific geographic area or in a foreign country. How fast is GDP? GDP is considered how fast the economy is growing, gross domestic product. And you divide 72 by the GDP growth rate. That tells you how fast the economy is growing. That's good to know. And can you use it to calculate a loss of buying power of a currency? So how inflation is affecting your money.
That's a great one.
Yeah, this is a very good one. So the U.S. runs at 2% inflation, more or less. 72 divided by 2 is 36 years. So that means that in 36 years, $100 turns into 50 in regards to buying power. So everything that cost $100 before, or everything that cost $50 before, now costs $100. Wow, that's pretty significant.
Yeah, I mean that's great. Also, I think to understand if you're doing international investments, so you understand how different economies are doing in the power, or like you're saying, the value of your money in different markets.
Yeah,
so this is fun. That's some good fun stuff.
Yeah, no, that's some great fun stuff.
Well, I think that's, is there anything else that we're going to add? Or I think we had a pretty involved podcast with a lot of information.
No, I think we covered the gambit.
I know for me, something to remember, one of the important things I make sure to remember is that the Rule of 72 does not work with the simple interest investments. It is for the compound interest investments.
Yeah.
So make sure to remember that. I have that notated.
Yeah, and then something I kind of harped on is you can also use compound interest if you're, let's say it works in other scenarios other than interest too, like stocks that pay dividends. If you invest your dividend payments into other shares of stock or something else, then you kind of are reinvesting and using that compounding power. So,
and I definitely think also another lesson that was really good to learn is, play around with the numbers in regards to your age currently, where you are and where you want to retire, to see how many periods you have between now and your retirement, so you can understand how much you will be able to have by the time you retired. If you're only doing something that is 6% or 2% right now, right? Because some people are only doing 2%. Maybe this is a great time to start diversifying some of your investments into other investments that have higher interest.
Yep.
So that you can accrue more money by the time you retire.
Yeah. So when you hear the episode and let us know what your doubling periods are and what you're focusing on, what type of investment. We'd love to hear you. Hit us up on Instagram for that. Cool. All right, guys.
Thanks for tuning in. I hope you enjoyed the discussion of the rule of 72 and feel better prepared to make investment decisions that will generate the returns you will need to meet your investment goals. To learn more about real estate investing or how you can be a capital partner, visit our website at www.everythingaboutwealth.com. If you like the show, make sure to subscribe and leave us a review on iTunes or your favorite app. This helps people find the show. So if you find the material valuable and want to support us, then make sure to leave a review. With that, see you on the next show.